that there is some cross interest there.
Hmm.
Sometimes they're enemies, but also there's a big component like myself that has been bullish on say Bitcoin and precious metals and stable coins, not really the rest of the altcoin space, but yeah, I think there's a lot of overlap in interest. Outside of Bitcoins and stable coins, I've been structurally pretty bearish on, and I think that that is kind of finally that's becoming more common knowledge, which is that the broader crypto space has been, Bitcoin's been around for 17 years, and it's structurally grown. It's made higher highs over time. Stable coins have structurally grown. Everything else kind of explored all these narratives, and didn't really build a sizable market.
Over the past year, financial markets have been anything but predictable. Stocks, commodities, and cryptocurrencies have all experienced dramatic swings, leaving investors unsure of what comes next. Global macroeconomic pressures, from interest rate shifts to geopolitical events, are reshaping how capital moves around the world, and many are asking, is this temporary volatility, or are we seeing a deeper structural change in the financial system? Renowned macro analyst and investment strategist Lyn Alden offered a clear and thoughtful analysis of what's truly driving today's markets. She separates the short-term noise from the long-term trends, showing why recent movements in gold, silver, and Bitcoin may reflect a historic revaluation of key reserve assets rather than mere speculation. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
Bitcoin is still a much smaller asset, and so it trades more like a risk asset. Lately, if you overlay software as a service stocks, so not the Nasdaq itself, which is a mix of stocks, but specifically like the software sector. If you overlay like a software ETF with Bitcoin, it's almost the same chart, somewhat different magnitudes because Bitcoin is more volatile. But they've both been sharply selling off. They previously rose together. So Bitcoin is heavily being traded like an AI play, whether it's the algorithms getting in, whether it's funds getting in. Kind of see the rise of AI and kind of the kind of combined sell-off of software and Bitcoin. So I think, yeah, those are fairly decoupled at the moment. I think Bitcoin is more cheap right now, whereas earlier last year, like in kind of mid 2025, that's when you had kind of the treasury companies getting really high MNAVs. That was kind of Bitcoin's semi-euphoric moment, whereas now it's more bearish. But I'm still structurally bullish on it. The part of the market that I think is fundamentally changing is the broader crypto space, which outside of Bitcoins and stablecoins, I've been structurally pretty bearish on, and I think that that is kind of finally that's becoming more common knowledge, which is that the broader crypto space, it's been, Bitcoin's been around for 17 years, and it's structurally grown. It's made higher highs over time. Stable coins have structurally grown. Everything else kind of explored all these narratives, and didn't really build a sizable market. And some of us have been arguing that it was never going to build a sizable argument. And then as they kind of went through the narratives, they've kind of gotten to the bottom of the barrel ones, like meme coins, for example. It's just kind of more like financial nihilism, where they kind of just admit there's no fundamentals. And so I think that the broader altcoin space is more in a persistent stagnation now, meaning it doesn't go away overnight. And there's still marginal use cases outside of Bitcoin stablecoins, but I think those are fundamentally very small, and that there is overhang in that whole space. There is cross ownership between all those assets in Bitcoin. Obviously, whenever the whole altcoin space has issues, the media will conflate Bitcoin with altcoins, even though I would say fundamentally they're quite different. So I am quite bearish on the broad altcoin space.
Is that healthy? Is that natural, or is that just out of the ordinary?
Well, I think it's natural when you've had a move that fast. I mean, obviously, the volatility and movements of this size in precious metals is just mathematically rare. This has happened only a handful of times in kind of the entire history of gold being a decoupled, pricing mechanism than the dollar. So since the early 70s, this type of kind of raging bull market has really only happened twice in the past. It's kind of the third major bull market in these metals, especially gold and silver. Platinum's still been somewhat of a laggard, but gold and silver having that really explosive market. And so it's natural that when you hit those records, they also get crash or kind of crash like scenarios, at least temporarily. Um, And now, but my view is that I don't think we crash all the way back down to kind of levels that we were at before. I do think that they're wherever they kind of find a bottom. I think it's still too early to tell as the dust kind of settles here. But I do think that this was a more fundamental re-rating up closer to where they should be, even if potentially overshooting it for a period of time, because I think these metals were structurally inexpensive just compared to the risk out there for sovereigns, for individuals that want to hold debasement resistant assets, especially ones that they have the option to custody themselves if they like to. I would say primarily on the periphery. And again, there's like core cause and and then there's like the actual like last mile, like what caused this particular sell off. There have been kind of some evidence that a fund in Asia has kind of crossed own some of these assets with leverage, and then when they get kind of blown out of one position, they try to fix it with another position, and then they get eventually blown out of that position. So that seems to potentially have been a cause here. I would say the overall kind of link between gold and crypto is still pretty small. So it is true that, for example, some of the largest stablecoin providers, such as Tether, they have been publicly stacking gold as part of their kind of excess reserves, and then also they've got gold stablecoin products that they've had for, I believe, going back to 2019, 2018, in that kind of time frame. So some of these kind of core products have existed for a while. They've historically not had a ton of demand. So in a world of trillion-dollar market cap Bitcoin, the demand for these kind of gold-backed products was only in the billions. It wasn't particularly attractive. As obviously as the price has risen, they've generally gotten more attractive. But then also when you have an entity like, say, Tether that has all these stable coins outstanding, so those are effectively liabilities for them, and then they put those in assets of some sort. Now, generally speaking, most of those assets have to be kind of correlated with their liability. So they're going to be dollar based. They're going to be T-bills. Before they were kind of like reverse repos and things like that. But basically, they are kind of money-like, dollar-like instruments that then earn interest for them. So they get a spread. And so that's kind of the bulk of it. But then they also say, well, we're going to put some percentage of it in Bitcoin, some percentage of it in gold. They've also that entity's made kind of private, kind of venture or private equity type of bets. So they've got this kind of assortment of other things. So the better the stable coins do, it can kind of feed into those other assets that they like as an entity on their own balance sheet as kind of excess reserves, as well as in their case, gold-backed stablecoins, and there are others like Paxos that have had this as well.
Alden also looks at the complex connections between gold, Bitcoin, and stablecoins. Some major stablecoin issuers like Tether hold gold and Bitcoin as part of their extra reserves and even offer gold-backed stablecoins. However, these links are still relatively small compared to the size of the global gold and currency markets. While they are building structural bridges between traditional and digital assets, they aren't yet large enough to significantly influence market prices. This trend shows a growing demand for neutral, censorship-resistant assets, especially from people and institutions worried about capital controls, frozen accounts, or financial surveillance. One of Alden's most important points is her perspective on the long-term evolution of the global monetary system.
I do think that we are entering a more structural world that is more interested in neutral reserve assets. Based on many metrics, the dollar kind of peaked as the global reserve currency in roughly the year 2000. Kind of lingering on into the early 2010s. Gold bottomed as basically a reserve asset in tonnage somewhere around 2009. So you had kind of multiple decades of kind of gradual drawdowns in gold tonnage, more of a shift toward the dollar and treasuries. But then after the global financial crisis, we started to get that kind of pendulum, pretty slowly going back in the other direction. And then more recent events in the past several years, the war in Eastern Europe and the associated kind of freezing of sovereign assets, as well as the fiscal dominance regime that the U.S. and many other countries are in that I've covered kind of from macro perspective. Like many of these sovereign debt crises are kind of slowly playing out. Demographics crises are slowly playing out. The sovereign ledgers of the big currencies, including the dollar, just not as attractive as they once were on a fundamental standpoint. So we are getting just more structural interest in gold as a reserve asset for these kind of multiple reasons. But then, of course, things can take a very long time. And then when they kind of start to gather momentum, that's when you get, I mean, algorithms jump on, people of retail gets very enthused after having considered it a dead space for a while. And so things can kind of get temporarily overdone. So I would not have guessed that we would have seen gold and silver hit quite the highs we saw in 2025 and early this year. I'm glad they did, but then it's natural that there's volatile corrections on the smallest reason, just because a move that goes up that fast has a fragility to it, which gives you some downside risk as well, of course. I mean, we had a relative strength index about as high as it gets for precious metals historically, kind of at around the same top end as like prior kind of multi-year or even sometimes multi-decade bull markets. We kind of hit those types of RSIs, and so it's natural for there to be kind of some digestion from that move, and there's always kind of a proximate factor, what caused this particular moment on this day. But basically, it's like the dry kindling was there. Of course, many point to the nomination of Kevin Warsh as the next Fed chair. I think that's somewhat overblown as a risk factor, but he's historically been more in the hawkish camp. And generally speaking, there's a correlation between interest in gold and more dovish or inflationary policy, and then less interest in gold when there's kind of a perception of more hawkish or sound money policy from the chief rival of gold, which is the dollar system. But I think that's overblown. But when you have all that dry kindling and you're so overbought, it takes any sort of reason for positions to say, okay, I'm out. Here's the top. We have multiple people were kind of prematurely calling the top in some of those, and then it just keeps going. But then eventually there is that cool down period. So we have, I mean, obviously there's paper gold and silver that can run into issues. You've got cross-border flows and price mismatches. You've got levered funds in the space. We started to get retail involved. I mean, I think gold and silver are still under-owned historically. In like a portfolio standpoint, many investment advisors still just basically don't touch it, where they have a tiny position. But there was some retail FOMO going on, and so there's multiple kind of things cascaded together, and just for a long time it was a pretty dead trade, but with a lot of asymmetrical upside and pretty low risk, because when you had especially silver and platinum were as cheap as they were, and gold was really kind of steady state. There's a lot of upside potential, and we got that. And just the challenge is when you've already gone up that far, you start to get more symmetric risk, which is you can go up a lot more than you expect, but you can also drop by 10, 20, 50%, depending on the metal we're talking about in a short period of time.
According to Lyn Alden, investors are becoming more interested in neutral reserve assets like gold as the global financial system enters a more structural phase. She notes that while gold reached its lowest point as a reserve asset in 2009, the US dollar most likely peaked as the world's main reserve currency about 2000 and persisted through the first half of 2010. Gold has been gradually dragged down for decades as the economy gradually shifted toward the currency and treasuries. Following the world financial crisis, however, the pendulum began to swing back toward gold, albeit slowly. More recently, geopolitical events such as the war in Eastern Europe, the freezing of sovereign assets, and a regime of fiscal dominance in the US and other countries have made traditional sovereign assets less attractive. This has fueled structural interest in gold as a reserve asset. Alden also explains that markets can move faster than fundamentals sometimes justify. The rapid rise in gold and silver prices in 2025 and early 2026, for example, was driven in part by retail enthusiasm, algorithmic trading, and a market that had been under-owned for years. While the metals were temporarily overbought, meaning the market could see short-term volatility or corrections, the underlying demand and structural factors remain strong. She notes that precious metals, particularly gold and silver, had been undervalued for years relative to the growth of fiat currencies, money supply, and bonds.